All right, everybody. We have got today Shawn Neely. He is with us. This is our third episode of what I'm calling Business in the Backwoods, and I am trying to just talk a little bit about some different businesses, what they're doing in our part of the state. Now, you're actually in the western part of the state, but you do a ton of business in the eastern part of the state. So that's kind of one of the reasons I wanted to have you on. Shawn's got a really cool background. He's got a military background. He's got a YouTube channel. He's got a mortgage brokerage. So I'm going to turn it over to you, Shawn. Maybe tell us a little bit about yourself and how you got started and all that.
Sure, thanks. Yeah, thanks for having me on here. This is awesome. So my name is Shawn Neely. I'm also known as the Mortgage Musketeer. I have a YouTube channel, the Mortgage Musketeer. You can find me either way, but it's really designed to help train and teach people about mortgages. Kind of take the mystery away from it. There's really no secrets in the mortgage industry. People think it's like this big mystery. It's all regulations and guidelines, but they're complex. So to be able to kind of sort your way through there and figure out what to do and how to do it is kind of the goal of the channel. And it's actually taken off in a direction I didn't expect. I have other loan officers that actually watch my channels so they can get better at what they're doing.
Yeah.
I have people reach out to me from all across the country, and that's the power of YouTube, is it can be anywhere, and I've had them call me up and say, hey, I appreciate what you're putting out there. I can't trust somebody here. Let me get your input, which is completely not what I expected, but it's good. But I also get a lot of folks that are in different states, not just where I am now, who are learning about mortgages so that they can navigate the loan process in whatever state they're in. Now I'm in 8 states, so I can handle quite a few. But most of my business actually is in Eastern Kentucky, which is interesting. And it's just how my business developed. It was very interesting. I linked up with a couple of really, really awesome realtors, and my business just kind of blossomed from there. And that's where I focused. And I come out there and I help. And what that's done is created, for me, a unique perspective where I understand the hometown there, even though I'm not physically there. I'm on the other side of the state. And it's just because of the amount of volume and the amount of people that I talk to every single day. I almost feel like I'm there. And in this virtual world, that's how most things are happening anyway. So, I get some of the culture, some of the things that happen out in Eastern Appalachia. And that informs me when I'm doing a pre-qualification and allows me to help everybody out there more so than your standard person who may not know the area.
Yeah. Yeah. So, go ahead.
Sorry, I was going to say, and as you mentioned, I do have a military background. I was 22 years in the Army. I retired. So I have that background that carries me in. And that informs kind of how I deal with a lot of the regulations, because the military is heavy regulation. The lending industry is heavy regulation. And that's kind of what has allowed me to kind of excel in what I do.
Yeah. What kind of made you get into the mortgage business? What was your...
So what happened is when I retired, I was actually hired by Amazon. So I was an operations manager with Amazon, and I was kind of a victim of my own success. Originally, when they hired me, they told me I'd have one department, I'd work 4 days on, 3 days off. I could do that standing on my head, right? So when I got there, it was a unique building. I ended up doing a lot more. I think I started off with 3 departments, untangled a whole lot of reverse logistic issues. Amazon is really good with forward logistics, not so good with reverse logistics. So I entangled a bunch of that, was a victim of my own success. They gave me more departments. We're going to, work on promoting, but I had no life at all. So one of my neighbors was a loan officer, and she introduced me to a brokerage, and I made a career change into the mortgage industry and never looked back.
Yeah. And now, how long have you been doing that?
In mortgages?
Yeah.
A little over 5 years.
5 years, yeah. Mm-hmm. That's cool, man. So I know, so you were big on kind of putting a lot of educational stuff out there on YouTube. Give us a couple tips that maybe give some tips that you would give another mortgage lender like you have been, or maybe some of the customers out there. I just saw a video that you did on budgeting. You're very straightforward with people, and I appreciate that. I like to incorporate that same straightforwardness when I deal with people too. So maybe you can kind of get some tips from that to help some people that might be watching the video or listening.
Yeah, and before I jump into that, just what you had said, being straightforward and telling people how it works, I wanted to kind of turn it back on you. And one of the reasons that I love working with you and your company is because of how good you are of handling the business. I deal with a lot of different insurance companies throughout multiple states, and I love working with people like you who get the job done. If we request insurance, you get it back. You got great rates. You got great service. When people need you, you're there to help them, and that's critical. And that's not always equal across the board. And that's why, I think we hit off so well, because I recognize, your business acumen, if you will, and how you take care of customers. So just wanted to put that out there, make that clear that, this is a great place to get your insurance. So
I appreciate that.
Absolutely.
That was not a paid advertisement.
Nope. That's the thing is, you have to know who you're working with, and, work with people that you like to work with because they're good at what they do, and they help clients. And that's what it's all about. So on that note, when I'm doing when I'm teaching this, it's really the idea of trying to educate people to make the process easier. And some of the tips that I would hit right up front, and especially for Eastern Kentucky, the first 4 videos that I did had to do with assets, with money, right? So people think that money is money and you can use any money and you just need money, right? Money, money, money. No. So the very first thing that I did was called Cash is the Devil. And that's because culturally, especially in Eastern Kentucky, people don't keep money in the banks, all right, for whatever reason. So where we run into problems in the lending industry, and understand that everything that we do is informed by federal guidelines. So federal guidelines tie into banks who are federally regulated, and those federal regulations, how it impacts us in the lending industry is the Patriot Act. All right, so Patriot Act deals with money laundering and terrorism. And because of that, you can't just dump a bunch of cash into your account and say, okay, I got money. All right, so when I'm doing a pre-qualification, I always ask very specific questions that other people won't. And it's about the specificity of the question where, okay, how much money do you have in the bank? I don't ask how much money do you have, or do you have money set aside for down payment or whatever. Or if I do go there and they say, yeah, I got money, big red flag for me. Yeah. Right. So I jump right in and say, okay, where is that money right now? Well, we got the money. Okay. Where is it physically located? Is it in the bank, or do you have it in a safe? Well, we have it in a safe. Okay. That right there is a big stop, or I have to help navigate or help get around it and understand the lending regulations so that people understand that money isn't money, right? It is money in the bank is what can be used because of the federal guidelines, and that people get a little bit disturbed about that because, I've had people say, well, it's American money. It's my cash. It's, I've earned it. And I said, that's great. However, we can't use it unless it's been seasoned for 60 days in the bank. So you got to put it in the bank, let it sit there for 60 days. There's other ways to get around it, but that's the very first thing that I jump into is, hey, you got to have your money. You got to have your assets in the bank or in other liquid assets that we can source. 401k, IRAs, investments. You can use gift funds, but those have to be sourced as well. And there's a whole other series of questions for that. I mean, I can go on and on, but that's the very first thing that I deal with is the assets, because assets are the hardest part. And then people move their money all over the place, move from checking to savings and savings to checking. And then, I only stop. Put your money in the bank and let it sit there, especially if you're going to be buying a house or if you're interested in it, because otherwise we have to be detectives. We have to chase the money everywhere it goes because of money laundering and terrorism.
Yeah. And I'm sure you've had some additional hurdles in the last 6 months with COVID, as far as getting people approved and the guidelines have been more stringent. So,
yeah. So, and that's actually a really good question, because I want to, potentially educate people on what happened there, because a lot of people don't know why. So all of a sudden it got more difficult to qualify somebody, and mainly that had to do with the credit scores. So there's 4 different types of loans. It's your conventional, FHA, USDA, and your VA. So VA is for your veterans. USDA is technically a zero down loan, but it's one of the hardest loans to get. I've got a video on that people should check out. And then FHA loans, your 2 most prominent loans are FHA and conventional. Well, those other than conventional, those other 3 are government-backed loans. and they're government backed because they give a little bit of leniency to buyers. So you can have a higher debt to income ratio, you can have a lower credit score. What that does is create a little bit more layered risk. When the government came out and had the CARES Act that provided the opportunity for people to have forbearance for up to 6 months, well, forbearance is not free money. And people thought, oh, I just don't have to make a payment for 6 months. It's not how it works. You know, you're still responsible for those payments. And at first, people didn't know what they were going to do with it, because technically, after the 6 months, you have to make up all 6 months and catch right back up again. Now, of course, they've realized that's almost impossible for people, so they've come up with some negotiations, but that's handled individually with the banks. All that being said, you don't have to pay that if you took forbearance, and hopefully you didn't have to, but if you did, the loan servicers were still on the hook for those payments because there are investors. All loans are investment vehicles. So if you don't make your mortgage payment, then the loan servicer has no money coming in to pay the investors. So that created a liquidity issue and higher risk. So what they did is they jacked up all the interest rates for government loans and put what's called overlays on the guidelines to typically like a 680 or above in order to get the loans. So it became a lot more difficult to get people who were in with a 680 or above into a loan. Now that has come back down. So most of the people that were going into forbearance have gone into forbearance. The industry has looked at the layered risk that's out there, and they pretty much figure that the worst has happened. And now a lot of the lenders are back down to 620 credit scores. You're still going to have a little bit higher interest rate on those because you're more of a risky borrower. And this is one of those tough love things, is people think, well, I just need, 620. Most people are thinking 580, and you'll hear 580. And you can do a 580, or you could. But right now, almost nobody's doing below a 620 just because of the risk factors. That will change. That will go back. Yeah. But as of right now, and we just over past month, just recently had lenders going back to a 620. For the longest time, some of them were capped at 680, then they came down to 660, some went to 640. All the lenders were different depending on their portfolio and the amount of risk that they were willing to take. Probably more than what you wanted to know in there, but yes, that is exactly why it became a little bit more challenging. But this is why we have to talk to people about their credit and how they're managing their budgets and how they're managing their money. And the idea of not paying your bill is a non-starter. It's not an option because it destroys your credit, and people don't think about that. You miss a minimum payment of like $25 on a credit card and think, it's not that big, I'll pay it next month. You just killed your credit score by 50 to 100 points. And people don't even know.
Wow. Yeah. And it's funny you say that, because your credit not only affects what you're trying to do, but it also affects their insurance.
Gotcha.
Because now insurance companies are so highly dependent on credit scores,
right?
Your credit history. So credit, yeah, like you said, it's not. I mean, it's huge for the mortgage payment, but I mean, all around, it would help you get a better score on your insurance too, and
right.
Whatever else you're working on. So I mean, that credit score is just a huge thing to work on. What do you do any kind of like credit counseling, or do you have any tips like for people to boost their credit score?
Yeah, so a couple key pieces. So first of all, when people go into, I pull credit every day, and I see all kinds of things, right? And the very first thing I hear, especially if they have a low credit score, is, well, you see what happened was. Okay, I understand, and I don't mean this from a non-empathetic way, but I can only deal with what's on there, and I understand that life has happened, but like a doctor, let's address the issue that we have here, right? So people have to be open to understanding that the credit decisions or what life handed to them has impacted them. The real question is, what are we going to do about it, right? So, and they have to be open to that, because if they've gotten themselves into credit trouble, it's going to take time and money to get themselves out of that. So if it's relatively simple, like if it's medical collections or paying down some credit card bills, that's relatively simple. Give some really good advice, knock that out, it'll raise your credit score. If it is multiple collections and, a whole bunch of stuff that is in arrears or collections, you're probably going to need some credit repair. And there's a whole process for that. And when people go into credit repair, and I have people that I recommend, I have a company I recommend people to, but they don't have to use them. They can use anybody they want. A company I won't mention here that I typically say don't use because I've just seen them take advantage of people, so I try to warn people. And not all credit repair companies are equal, so be careful about that. But you're going to need some type of credit repair in those instances. Now, let's talk real fast about medical collections because I see this the most. A lot of people don't even know they have medical collections when it hits, okay? Because the biggest thing here, well, insurance was supposed to pay that. They didn't. Now it's on there, and you're left fighting for it because most of the time, the hospitals have already written it off, and they don't care. So it's in collection. So you can be mad and upset, and it's not fair, if you will. And the only fair in life is where you go to ride rides and have a good time. You got to deal with what's on your credit report, right? So you've got two options. You can dispute it and go through some type of credit repair and work on that side of it, or you can do what's called a pay for deletion. But understand this on a medical collection. The lending industry doesn't care if you have medical collections at all, other than the impact it's had to your score. So if you have $20,000 in medical collections, but you've got a 700 credit score, could care less. The credit collection agencies know that. They know that they have no leverage. So a lot of times if you call them and say, if I paid this medical collection today, will you delete it from my credit report? Keyword, delete it. Most of the time they'll say yes. Most of them, probably about 90% will delete it from, and that's the key. It's called a pay for deletion. If you just call up and say, hey, I'm going to pay my medical collection, they'll say, thank you for the money. And then what happens is they update it. It shows a zero balance, but there's also something called a DLA, or date of last action. And that date of last action then updates to the date that you paid for, and you actually have a negative impact on your score initially, because that will stay on there for 7 years. It looks as a new collection, even though it's a zero balance.
So tell me that, all right, when you call the medical collection company, that's who you need to say you need to delete it?
Yep. So you call them and say, if I pay you today, will you delete it? Will you provide a letter to that effect that you're going to delete it from my credit report? If they say yes, you can pay it, and then they'll delete it because it's going to remove it from your credit report. If they say, no, we don't do that, say, thank you, hang up. It does you no good to pay it because it's already done its damage. And if you pay it, it's going to make it a zero balance. It'll update the date of last action and have a negative impact on your score initially.
Wow.
And it'll be on there for 7 years.
I did not know that. That's huge.
Yep. So
Huge
a lot of people trying to do the right thing will call up, pay their medical collection, and they say, well, I paid that. And say, yep, it shows a zero balance. And there it is, still on your credit report and still impacting you. So it's pay for deletion is the key.
And I guess you get the number from the collection company from your credit report, right?
Yes. So I will often do it kind of like a snapshot, and I'll send the actual collection and the different numbers to who to call.
Gotcha.
GLA is the easiest one to deal with. They'll make it go easy. There's a couple, and it also depends on who you're talking to. So often I'll tell people, call them. If they say no, they won't do it. Say, thank you, hang up, call them back. Hopefully you get somebody else who's a little bit having a better day.
Yeah, I use that trick on different places too.
Right.
Sometimes you don't get the answer you want. Sometimes you're like, I'm gonna try back somebody else answers the phone. Maybe they'll do it for me. Yeah, that does work. So.
But yeah, so that's the key on medical collections, and other collections may do it. And I have heard that during this whole COVID thing, some who ordinarily would not do a pay for deletion, like regular collections, some are doing a pay for deletion. So it's always worth calling to try and settle. Otherwise, what happens is you go through, the other way to do medical collections is through disputing, and you're using the was it the Federal Fair Credit Reporting Act, where if they don't respond within 30 days, they have to take it off the credit report, or if you demand proof that it's your medical, because they'll verify it. In the first round of medical, if you're doing credit repair, the very first round of credit repair, they're going to verify all of your collections because it's a collection company. Of course, they're going to say it's your debt. Yeah. So it's going to take several months in order to kind of go back with letters and more letters, and then it's basically, okay, prove it. And if they have, something with your signature saying, boom, hey, here's your debt, then you're like, oh, okay, But medical collections, if they do that, if they come back and it has any type of medical information, they've violated HIPAA. And once they violate HIPAA, they got to take it off.
Gotcha.
Yes. Huh. Lots of tips and tricks. I know enough to be dangerous, but when it really gets into big credit repair, I always refer it out to the experts who have lawyers and lots of experience dealing with that. I know enough to give some good guidance. The other thing too that I will talk to people about is, because we're talking about credit scores, is credit utilization. So people think that two things here. First, installment loans. People say, well, I paid off my installment loan, so my credit should go up. No, it's an installment loan. You know, the only thing other than the fact that you have it and it fills a box on your credit, if you have any late payments, that'll negatively impact you. The expectation is that you make your payments on time, and the expectation is that you pay it off. Where you need to focus on is your revolving credit. You're dealing with your credit cards. Okay, so it's about credit utilization. So there's actually a mathematical formula, and the reality is 0 on your credit card is the best. But if you have no credit and you're trying to establish it, or if you're trying to lower your credit utilization, get it below 30% utilization. As an example, if you have $1,000 limit, you don't want to ever have more on any credit. You never want to have more than $300. You never want more than 30%. Once you get above 30%, the way that the algorithm works is it has a negative impact on your score. Once you're above 50%, essentially what you're saying is that you can't manage your credit, which is interesting because the credit card companies want you to max them out, of course, right? And the credit bureaus and the credit score want you to manage your credit. So when people, and this is also important, so you'll hear a financial advisor, and we need to differentiate this, okay? So let's say you've got a 0% APR card, and your financial advisor is saying, hey, move all your debt onto this card, and now you've got a 90% utilization, but you're not paying much interest, or maybe it's low, 1 or 2 or 3%, right? Well, financially, that's a good decision. Financially, that makes sense if you're trying to reduce your debt and pay it off. From a financial advisor, that is spot on. That's the right thing to do. From your credit score, that is not the right decision. So if you know you're going to be making a purchase in the near future, by maxing out your credit card, even though it's a low interest rate, you just jacked up your credit utilization and lowered your score. So you have to understand the difference between the two goals and manage your credit appropriately. And on that note, people are afraid of credit. They say, I'm not going to get a credit card.
Right.
Well, you need credit. The way that our world works, you need credit because everything is based upon that. The difference is whether you manage it or not. So understand it, use it as a tool, and manage your credit, and you'll be good, right? And that's the key, is understanding and having the maturity to manage that credit.
Gotcha. Yeah. So how does it work with a home equity line? Because that's considered a revolving line of credit too, right?
So a home equity line of credit is actually a mortgage. Right.
Okay.
So although we often use it like that, it's a second mortgage. So it's a second lien. So when people get a HELOC or a home equity line of credit on their house, it's actually a second mortgage that they're putting on their house. I got one myself. I went out and got it just so I'd have it available. I'll leave it at a 0 right now unless I need it. It's there for emergencies.
So, I mean, from a credit standpoint, it's considered a mortgage, not a revolving line of credit.
That is correct.
Cool. Okay.
Even though we tend to kind of use it like a revolving,
Right.
You're just leveraging the equity in your home, but ultimately you have a second mortgage. So if you ever refinance or sold your home, that HELOC has to be reconciled at the same time, because it is a lien on the house.
So how does that work? Does the second mortgage negatively impact your credit?
No.
Or does that improve your credit because you've got another payment you're making?
Yeah, it's just another loan. It's like having a mortgage. So it doesn't negatively or necessarily positively impact you. It's just another line of credit.
I got you. I've always heard,
unless you miss a payment, and then it.
Yeah.
That's what people need to understand. I see it so many times that it's like people just I didn't make that payment. You just killed yourself.
Yeah.
Oh, one last thing, because this is my soapbox on credit repair. On credit repair, because I've been seeing it so much recently in the past 2 months. I've got these people in credit repair, and they're doing great, and stuff is coming off of their credit report, and then new collections hit. Come on. You're doing credit repair, and then you don't pay your bills. What in the world is going on? It's like going in the middle of an ocean and shooting a hole in your boat. Stop. Make your payments.
Yeah.
Right.
Yeah. I mean, there's more to, I think, like in one of your videos, there's more to owning a home. I mean, you got to get yourself mentally ready.
Yes.
It's different than renting. You've got more responsibility here. You've got to prepare. You got to prepare for the process, like you said. I mean, you've got so much to do with your credit. If you don't have that in line, there's you've got a budget. There's just so many things you have to do just to get to the point where you can buy the home.
Right.
So.
Yeah. I mean, you got to figure out your budget. And that's kind of what you referenced in the beginning about the budget. You need to know what money you're spending, where it goes, and you also have to plan for some contingencies, because once you're a homeowner, then you realize there's so much more to it. Everything as simple as it sounds, everything from mowing the lawn, because that's going to create, the need for gas every month, plus the maintenance and the time and the energy, all the way down to bath mats or curtains and blinds and all. There's all these unexpected expenses that people don't know about, let alone if a water heater goes out, if your AC goes out, or plumbing issues, a myriad of other things. You need to have some type of cushion set aside where you can take care of that, whether that be a cash cushion or a line of credit for an emergency. Again, managing credit. But yeah, so you have to know your budget and you have to be prepared for things like that.
Yeah. Yeah, it's just funny because like yesterday I got my electric bill.
Yeah.
It's like double, and I'm like, so that automatically tells me that something's wrong.
Yes.
Either with my hot water heater, my heating and air system, or some other huge appliance.
Right. Right.
So so it's just like for that instance there, you've got a $200-300 more bill on your electricity you got to pay. Then you got to find out what's causing the problem. I mean, I could easily be out $400 or $500 in that one little.
Right. Yeah, I had the same thing happen to me with my water main. Right where it goes from the house into the meter had a leak, and I realized it when I have drainage ditches that go around my property, and it was always wet, and I was wondering why. And then I actually discovered it had like this seepage, and then I got my water bill. And I'm like, oh hey, so we reached out and had the water company come in. Luckily, it was on their side, but if it was on my side, I would have been responsible for it.
Yeah. You know what you can get to help out with that?
What's that?
There's a service line endorsement you can get on your home insurance policy.
Nice. I love it. Yeah, there's a lot of things with insurance that people don't know either. We should maybe flip this around one time and talk about insurance.
Yeah, love to.
Yep, because there's so much that people don't know about insurance. It's a whole other world. Like even myself, I'm like, do I got insurance? Yep, cool. And that's the extent of my knowledge. And I make sure I pay it so that I'm insured.
Yeah. You're right. Everybody thinks that it's just try to get the cheapest deal I can get. And, there's a whole lot more to it, especially when you get into home insurance. There's a whole lot more to it than a lot of people realize. And
right.
Yeah, I'd love to sit down and do that sometime. I can get in depth on some home insurance stuff.
Yeah, we might have to flip this around here. Maybe we'll do it next week.
Sounds good to me. Shawn, I'm going to be mindful of your time. We've been on here about 30 minutes, so I appreciate you coming on, talking a little bit about what you do. Again, just tell everybody again how they can get a hold of you, where they can reach you at.
Yeah, so you can reach me at, you can check out the YouTube videos. Those will be helpful to you. You can find me at Shawn C. Neely, Neely, SHAWN, or the Mortgage Musketeer. And you can give me a call anytime that you want, 502-310-8405. Most people out there know my other number, which is 803-476-6733. It's a South Carolina number from when I was in the military. So,
okay.
And of course, Shawn at ufglending.com. That's for United Financial Group, ufglending.com, SHAWN.
Awesome.
All right.
Sounds good, man. Have a good one. Good talking to you.
Yeah, I appreciate it.